Two people earn the exact same salary. They live in the same city. They have similar jobs. And they start with the same amount of money. Fast forward 10 years. One is still trading time for money. The other is collecting income from investments. Same salary, different outcome. So what happened? The answer has less to do with how much they earned, and more to do with what they did with their money. Today, we're breaking down how passive income from the stock market works, and why it has helped ordinary people build wealth without working extra hours. When most people think about making money, they think about working. You go to work. You get paid. Simple. But there's a problem. Your income is tied directly to your time. And there's only so much time in a day. That's why many investors focus on building passive income. Money that can continue coming in without requiring constant effort. One of the most popular ways to do that? The stock market. Here's something many beginners don't realize. Some companies don't keep all their profits. Instead, they share a portion of those profits with shareholders. These payments are called dividends. In simple terms, when you own shares of a dividend-paying company, you may receive regular cash payments just for being a shareholder. Think of it like owning a tiny piece of a business. When the business does well, shareholders can benefit. And these payments can arrive quarterly, sometimes monthly, depending on the investment. Pretty interesting, right? But here's where things get even more powerful. Let's say you receive dividend payments. You could spend that money. Or you could use it to buy more shares. Those new shares can generate additional dividends, which can buy even more shares. And the cycle continues. This is called compounding. At first, the growth feels slow, almost boring. But over time, the effect can become massive. Imagine rolling a small snowball down a hill. It starts tiny, but as it rolls, it gathers more snow and becomes larger and larger. That's how many long-term investors build wealth. Not through luck, not through chasing hot stocks, but through patience and consistency. Now, before you start thinking this is some magic money machine, there's something important to understand. Passive income investing is not a shortcut. It takes time, years, not weeks. And that's exactly why most people never stick with it. Why most people fail? 3 to 340. We live in a world that loves instant results. People want fast money, fast success, fast everything. But investing rewards a completely different mindset. The people who often benefit the most aren't necessarily the smartest. They're the ones who stay invested. They keep buying. They keep reinvesting. And they give their investments time to grow. That's the part many people underestimate. Time can be one of the most powerful assets an investor has. Remember those two people from the beginning? The difference wasn't their salary. The difference was their strategy. One relied only on earned income. The other built income-producing assets. And over time, that decision changed everything. The stock market isn't just a place to buy stocks. For many investors, it's a tool for creating long-term passive income and financial freedom. If you enjoyed this video, hit the like button and subscribe for more investing and wealth-building content. And let me know in the comments, what's your biggest question about passive income from investing? Thanks for watching, and I'll see you in the next video.